Hi, we are going to be talking today about Chapter 14, and this chapter is all about making capital budgeting decisions. So in other words, I've got some capital I want to invest, and how can I choose what to invest it in, right? And of course, you're going to base that on the return you're going to get. Now, this chapter is going to rely pretty heavily on you understanding time value of money, right? So that if I am going to receive cash in the future, it's not worth as much as cash today. So we have to discount that, and we have to choose a rate of return for that. So I'm hoping you kind of understand this concept of the time value of money. We'll talk about it a little bit, but this is something that really is discussed in Intro to Finance. Big time. This is kind of what the point of the class is to understand present value of a dollar and present value of an annuity and future values. So I'm hoping you already have a pretty good handle on that. We'll discuss it some, but this kind of assumes that you understand, what present value means and future value. I mean, they kind of go hand in hand. But anyway, so we're assuming that. All right, I hope it's not too big of an assumption. So, right, capital, you got to invest it, right? You want to make some money. So typically for an organization, you're investing your capital in things like machinery and equipment and plant expansions. Sometimes you're investing in other organizations, right? You're going to buy out another organization or invest in part of it. Maybe you're going to invest in, purchasing something. It's a capital investment. So how do we decide if it's a worthwhile investment or not, right? So you have to think about, gee, there's a whole world of investments I could be making if I have some capital that I want to invest. So typically, there's two broad categories. Does this project meet some preset standard, right? In other words, hey, if we can find a project that will make us 12% return, we're going to do that. And if not, we won't. Or there's a preference. We're going to have several competing choices for our investments, right? I can buy a machine that does this. I can buy a building that does this. I can lease a machine that does this, right? I need to figure out which is going to give me the best return. So that's what capital budgeting is about, figuring out if I want to invest my funds in this certain way. Okay, so very simply, there are kind of three main ways that we think about investments and whether or not we want to make them. We can look at payback, net present value, and internal rates of return. And these analyze the cash flow. So in other words, when you're trying to decide on a project, I'm going to buy this machine, I'm going to invest in this other company, we need to be able to project those cash flows. Like if I invest in this company over the years, this is what my returns will be. And then I can decide that return, is that sufficient based on the amount of capital I have to invest, right? Am I going to get back 10% on my capital? Am I going to get back 1%? What am I getting back on this estimated stream of money cash that's going to come my way, right? So when you're making a decision about an investment, right, cash flows out and it flows back in. And it's not always, here's a big chunk of money down. I mean, especially when you're an organization that's doing something like investing in equipment or something, there's not just a one-time layout of cash. There can be a one-time layout of cash, don't get me wrong, but frequently there's initial investment, there's operating costs, there's repairs. So cash can flow out in different scenarios. Working capital flows out to keep it running. But you also get some cash flow in. So hopefully you depending on what you're investing in, maybe you'll get more revenue, maybe you'll have less costs. You know, maybe you have some salvage value at the end when you sell it, if it is something that can be sold. So you've got cash inflows and outflows, right? And so hopefully you'll have, a positive cash inflow. That's the point of the project. If it's a negative cash inflow, you don't want to do it. But also if it doesn't meet your required rate of return, you don't want to do it, right? So you have to filter this decision through the time value of money, right? Because if you're making a capital investment, typically these capital investments are lasting for several years, right? Otherwise, it's an operating investment. It's an expense. I'm just doing it this year. So if I'm making a capital investment, it's long term. I'm expanding my factory. I'm buying some new robots, some machinery, right? Things like that. I'm investing in another company because I want to get access to their patents, or I want to vertically integrate, and so I want that part of my supply chain owned by me, right? So investments. Well, these aren't paying off, right? So they're long-term investments. So they're not paying off over like a single year typically. I mean, I suppose they could. You could hold something that has no cash flow and then sell it at the end and get one lump of cash, I suppose. But that's not typically the kind of investments we're talking about. We're talking about you've bought a machine and it's going to help you with some more additional revenue, less costs. So you have cash flowing in over years, right? So if you have cash flowing in over years, you have to consider that a dollar today is worth more than a dollar tomorrow. So I want the cash flowing in sooner, and for that cash that's flowing in the future, right, I need to consider its present value today, right? So I can look at it today and make my decision. So I have to discount those cash flows. Not always. Sometimes I just do payback period, but I need to consider that I want this money paid back, and the sooner the better. A dollar today worth better than a dollar a year from now. Okay. So capital budgeting techniques involve discounted cash flow. So discount means yes, I'm going to get a certain amount of cash in the future. Like say 2 years from now, I'm going to get $100,000. What's that worth to me today? Right. In other words, if I had that today, what return could I get on it if I invested it? Right. So I have to discount that. I can't just say, well, that $80,000 I'm going to get in 2 years is not worth $80,000 today. I don't have it today. I'm going to get it in 2 years. Right. So I have to discount it. All right. So if you don't understand this, well, you could get in touch with me. I could give you some reading and some information about time value of money and how discounted cash flows work, present value of a dollar, present value of an annuity. Like I said, those are things that should have come up in leveling classes, especially intro to finance. You should probably understand time value of money. So the first method we're going to talk about actually doesn't require any discounting. It's just called the payback method. And it's pretty simple, pretty basic. It says, if I spend this much money today, when will I get it paid back? Right? How long will it take it to pay me back? Right? So it does consider the cash flows, right? But it does not consider the time value of money, which is obviously not optimal. So you say, what is my payback period? Is it 1 year? Is it 2 years? Is it 3 years? What's my payback period? That's what you want to, that's the answer you want to know. What's my payback period? If it pays me back in 3 years, I'll do it. If it's not paying me back for 10 years, I won't do it. I need my payback within 3 years. Something like that. So to figure out the payback period, you just take the amount of the investment, divide it by the annual cash flows, the net inflow, because you could have some outflow, right? Again, investments sometimes need upkeep and maintenance. So you can have cash outflow associated with it. So your net cash inflow, investment divided by net cash inflow, how long it takes to pay you back. So here you go, very simple. We're going to install an espresso bar. It costs $140,000. Will generate cash inflows of 35, right? After expenses for the not variable expenses for making coffee, right? It's the expenses related to the machine. Just going to make net cash inflow of 35. Requires a payback period of 5 years or less on all investments. So, well, how was the payback period on the espresso? 140,000 divided by 35,000 per year. Payback period is 4 years. So, hey, less than the payback period, 5 years. Pretty simple. All right. So, are you kind of starting to see some flaws here? Is $35,000 4 years from now worth the same as $35,000 today? No, it is not. All right. So let's look at two projects. We got Project X and Project Y. They both cost $100,000 initially. So there's your cash up front. Outflow, 100,000. How's it going to flow in? Well, first year for Project X, 60 is going to flow in. The year 2 for Project X, 40 is going to flow in. There's my payback. So here's my payback. It's a 2-year payback. Now after that, we don't get anything. So basically, and of course, not even factoring in the time value of money, our payback is 2 years, but that's it. There's nothing after that, so far as I can tell. Project Y, 100,000. First year, 60,000. Next year, only 35,000. You're not quite paid back yet. So this payback is a little over 3 years. Right. So if you went on payback period, which would you invest in? Oh, payback period, Project X. Yeah, this is the one. I'm paid back in 2 years. I don't make anything, but I'm paid back. How about Project Y? Well, Project Y, I'm paid back in 3 years, a little over 3 years. But in addition to that payback, I will have an extra $20,000 in year 3. So, you know, the shortest payback period, yes, is Project X, right? But I don't think I would invest in Project X. I might invest in Project Y. I would still want to know, in terms of present value of a dollar, $20,000 3 years from now, what's that worth today, right? So it's still a little short for me to actually make a decision, but that would be easy enough to figure out. So here's paybacks. Ignores time value of money, not my favorite thing. Ignores cash flows after the payback period, as we saw, turns to 0 after year 2. Other one continues going on. So in other words, shorter payback period does not always mean a more desirable investment. What's the advantages of? Well, it's pretty easy, right? My goodness. It's not bad as a screening tool. I mean, if it's not going to pay me back within 2 years, I don't want it. So I can quickly get anything out that's not going to do that. Pretty easy. Identifies quick cash recoup and products, right, that are going to get the cash back quick. So I don't think it would be my ultimate final decision maker. I wouldn't base my final decision on payback method, but it might help me weed out a bunch of things that I don't want, you know. Okay, so another thing is, you know, some years the payback is word. I don't know. You might have. I can't really think off the top of my head an example where you would have a situation like this. Well, I suppose if you're a winery, all right. So if you're a winery and you grow grapes, in year 1, you could have a harvesting machine or something. Let's say you're going to invest in this winemaker or something, and so you pick the grapes and you sell some of the grapes. But then in year 2, you don't have, right? You make the rest into wine, so you don't really have anything in year 2 because you can't start selling the wine till year 3, maybe something like that. It could happen, I suppose. Some kind of wine equipment, and you sell some things that you've used with it in year 1, and then you wait till it ferments and start selling it in year 3. Yeah, so, you know, there could be something. All right, just to give them the benefit of the doubt, yes. there could be, and it could be also some kind of contract for some kind of construction problem, that you are getting paid in increments as you finish stuff. And in year 2, you wouldn't be able to complete anything. Year 1, you complete part of it. Then year 2 is a very lengthy process of getting something. So yeah, I suppose you could have contracts and things that were like that. All right. So let's suppose this is your situation, and how do I do my payback? Well, you just do it the same way. I mean, here's 1,000. Oh, I don't like that color. Here's 1,000. Here's nothing. Here's 3,000. Here's 4,000. So my payback is year 4. Takes 4 years, right? They aren't always even. Cash flows are not always even. So think about that. Now we're going to talk about net present value method. All right. So we're going to compare the present value. So in other words, these cash flows in and out, they're happening over years. So I'm going to bring everything down to the present day. All right. So out in year 5, if I'm getting some cash flow in, I'm going to discount it to today. In year 2, we're going to discount it to today. And of course, we use different discount rates depending on what year that cash flow is coming in on. But we're going to get everything all kind of brought into today's dollar, right? Because if some of this cash flow is happening next year and some is happening 5 years from now, that matters. And so I need to account for that, right? So we're going to take the net present value of each year. And outflow, there's outflows too, and so we have to take the net present value of the outflow too. So so that's a thing we can do. So 2 assumptions. One is just cash flows are at the end of the period. So that way it's like if I say I'm getting it in year 2, I'm getting it at the end of year 2. So I have the benefit of the full year, and I discount it for the full year for year 1 and year 2. If it's year 3, I'm discounting it for the full year 1, year 2, year 3. Right? So it's like full year's worth of discounts. Also, there's some rate of return that's equal to the discount rate. Right? So in other words, when I calculate my net present value, I'm going to calculate it based on some rate I can invest something in, like a T-bill, right? Or, well, I can always, my rate of return on assets here at my factory is 18%. So if I'm going to bring something else in, I don't want to lower my rate of return. So it needs to, be 18% or not doing it, right? So there needs to be something where I can invest my money and get a certain rate of return, right? And that's what we're going to call our discount rate. So when I calculate my net present value, I'm going to apply a discount rate. And so I have to pick some reasonable rate. I mean, if I pick a super high rate, well, the cash flows are going to get so small in the present value, it may not be worth it, and it's not even realistic. I can't even get that rate anywhere. So you kind of want to pick a realistic rate that you're using for a discount. And that's up to the organization. Anyway, here we go. Net present value method. So here's a list of cash flows. There's a 5-year contract to make parts. So here's Lester Company's a manufacturer, and they make parts. And somebody's saying, hey, we want to contract with you, and we're going to buy your parts. So what would be the value of this contract, right? Should we do this, right? Because it's going to take some special equipment, right? And I'm going to have to spend some working capital to get going. I'll have to do some maintenance to this equipment after 3 years. At the end of this contract, this machine will be worth $5,000, so I'll sell it. And the contract, I'm going to get revenue of $750. Here's my cost of goods sold, $400. So all my variable, my raw materials, direct labor, and manufacturing overhead all goes into cost of goods sold, and that's it. So, and here's my selling and admin expenses, right? So I have to consider this and say, okay, is this contract going to be worth it? And remembering this revenue is every year for 5 years. This cost is every year for 5 years. This is every year for 5 years. This is a one-off. This is a one-off. This is a one-off. This is a one-off. All right, so we need to consider, right? So if we're taking net present value, these cash flows are happening in different years, right? So I've got to think about that. So we're going to use a discount rate of 11. So I'm guessing that maybe Lester Company, they already know what their rate of return on assets is, or they have some investment they can make where they'll get 11 or something. So they're using 11, right? So this is how they decide what discount rate to use. It's kind of like, well, what can I invest this money in and earn this in interest or something, right? So 11%. And so when we look at these discounted cash flows, discounted at the rate of 11%. All right, so what's my net cash inflow? All right, so if you come back here, right, and here you go, this is in, right? So this is coming in, right? This is going out, this is going out, right? So 750 minus cost of goods sold minus selling and admin expenses, whatever you want to call that. And so here's my net cash flow in. All right, my net cash flow in is 80,000 from this contract every year for 5 years. 80,000 is flowing in. At the end of year 1, year 2, year 3, year 4, year 5, get 80,000 bucks net, right? So I can use that, right? And now I need to set up, I'm going to set up a little chart here that helps me think about this. All right, so remembering that we're going to calculate the net present value. And to do that, you need to find the net present value factor. Now, maybe when you learned it, you looked it up on a chart. Or maybe you learned how to do it in Excel. You know, in Excel, you just go in Excel and you type equal in PV, and then in the brackets, you type your percent rate and your cash flow, and it just calculates up the net present value for you. You could go online and type in something like present value of $1 table, something like that, and you come up with the little factors. All right, so these net present value factor, and you would look it up at the rate, right, 11%, and the year 1, year 2. So right, it would so this table has interest rates and years, right? And so you find your year and you find your interest rate and you find this factor on the table. Or you can look it up online, or you can calculate it using Excel. It's called NPV. All right. So anyway, so we're calculating, right? So the first year we have to invest in equipment and we have to invest in working capital to do this. And the reason the factor is 1 is because this is today. There's no present value being calculated, right? Because this is now up front, right? So my cash flow times my factor of 1 is 160. So these are cash flows out, right? Okay. Now, every year for the next 5 years, I'm going to get a net of 80,000 cash flow in. Right? So years 1 to 5, 80,000. So my factor, right, it is 3.96. Now, where did that number come from? Well, somebody went to the present value of an annuity. All right. So this here they tell you present value of an annuity, right? So they found a present value of an annuity table or something, went somewhere, and you can probably Google it. Present value of an annuity, 5 years, 11%. It probably gets to tell you what it was. And so anyway, So that's where that factor came from, a present value table, right? And it's an annuity because we're getting this every single year. An annuity is a flow every year. So 80,000 every year is an annuity. All right. So present value of an annuity, right? 5 years, 11%, right? So it's because it's 5. All right. If this was year 1 to 6, you'd use present value for 6 years at 11%. All right. So the factor is 3.96. You just take 80,000 times 3.96, and you end up with this 295,680. So that's what a cash flow of 80,000 per year for 5 years, discounted at 11%, is worth today. 295,680. So yeah, so if you just took 8 times 5, you would get 400,000. 80,000 times 5, you would get 400,000. But it's not worth that today, right? Because think about over 5 years, I could have invested that and earned 11%. So even though I'll get 80,000 every year, and it would add up to 400,000, that's not what it's worth today. If I had 400,000 today, if I had that money today, it would be worth 295,680. So there's my present value of the cash flows. But there's a few other things going on, right? There's, in year 3, we're going to have to do some maintenance on the equipment. And so that's in year 3. So the present value of 30,000. So this is just this is present value of $1, not an annuity. The present value of a dollar, not an annuity. Present value of $1 for 3 years at 11. So you find your chart, 3 years, 11. That number is 0.731. So 30,000 times 0.731, there's a cash outflow of really today of only 21,930. All right, and you go on and you do the salvage value, right? So at the end of the 5 years, I'm going to sell it for $5,000. The present value of $1, because that's not an annuity. I'm not getting 5,000 every year. I'm just getting it once. So that's the difference between 80,000 present value of an annuity, because I'm getting it every year for 5 years, and this 5,000 and this 3,000, because that's just once in that year. So out in year 5, 5,000. So the present value of a dollar at 11% is 0.593. And so that is brought back to today, would be present value of 29.65. My working capital that I had tied up here is now released. And of course, $100,000 after 5 years is $59,300. All right, so at the end of, so today, the net present value of that contract is $76,015. It has a positive net present value at 11%, right? So if I change that to 12%, it would be different. If I changed it to 5%, it would be different. But at 11%, which is what we feel like we should be able to get for our investments, this has a positive net present value. So we're going to do it, right? Okay. So we can do this again. We can look at another one. Here's a 4-year contract, supply computing requirements for a bank. And so we have some equipment we're going to have to buy. We're going to have to tie up some of our working capital. We'll have to upgrade the equipment after 2 years. We can sell the stuff after 4 years. And every year, net, we'll be getting 120,000 cash. Now this time, our rate of return that we're looking for, our discount rate, what we're going to discount the cash flow at, is 14%. All right, so what's the NPV? Well, let's see. It's kind of tough to tell without actually calculating it, right? So here we go. The answer they're telling us is 28,230. And to look at that, so here's the outflows right now, right? And they're, of course, 1 to 1. right? They're today, so there's no need to discount it, right? So outflow 250. Then my annuity, right? My every year I'm going to get $120,000, years 1 through 4, right? Now I know that 4 times 120,000 is 480,000, but we don't have it today. We want to bring the value to today, the net present value, today, present value, right? So I look up that factor, 4 years on the annuity table, 4 years at 14%, and it gives me this factor. I look it up, it says, oh, here's your factor, 2.914, or I Google it or something. So 120 times 2.914 is equal to this 349,680, so that's a cash flow in, right? Then they told us we had to upgrade, so that's going to be cash flow out. It happens in year 2, so the net present value of $1, because this is not a flow, it's not an annuity, of $1 at 14% over 2 years is, here's my factor, 0.769. So 90 times 0.769 equal to this, 69,210. This in the end of year 4, we're going to sell that stuff for 10,000. So I go to my table and I go year 4 at 14%, the $1 table. It's not an annuity, it's not a stream, it's just a one-shot deal. So $1, 592, and so 59.20. Same thing with my working capital, it gets released now, but now today it's only worth 11,840. So I add these all up, and at discount, and even though it's discounted at pretty high rate, 14%, you can see that we are positive net present value, 28,230. So let's do it. Okay. Now, so that's looking at it from an annuity perspective, right? In other words, we took the present value of an annuity, but we're going to do the same thing, discount rate of 11. Let's check it out. So here's that same deal, right? So still 11%, still have to have this initial investment. This is the one we did already, right? So in the right now, there is no discount, right? It's 1-to-1, so 160 and 100,000. So you don't need to discount it. Then we've got those years of cash flow at 80,000 each. So remember in the last one, we just did annual net cash flows 1 through 5, 80,000, and we took the present value of an annuity. I'm going to stop right here. It's telling me I've got a poor connection, so we'll come back and pick this up on the next video.